The new labor code is widely discussed as HR or payroll change. However, there's a serious misunderstanding. It has an impact on financial risk because it can impact your profitability, net worth, EPS, and so. So this video primarily focuses on not only on summary of the law, however, how it impacts accountant, auditors, actuary, and what are the perspective to look after as far as completion and finalization of the quarterly result is concerned. So first and foremost, there are 29 labor laws they have been enacted and they are consolidated into 4 labor codes. It is effective from 31st November 2025. The rules which are going to provide detailed information is awaited. Immediate accounting. Sometimes it has been assumed that this may have impact on year end or probably on quarterly basis only limited review. We may ignore the impact. However, it is effective from 21st November 2025. We need to even understand its impact on immediate basis on the quarterly basis. And professional reality is one of the most important point which I would like to highlight here is that please don't consider this only as a compliance or of HR or payroll. It has a definitely impact on your financial statements covering the defined benefit obligation, then profit and loss statement, actual gain or loss, or other aspects which impact the P&L account. Let's first look at what has been changed. There are primarily two triggering points. First trigger which make impact is about the change in the definition for completion of gratuity. What it says that wages which is considered to include the basic plus TA plus retaining allowance that should be at least 50%. Wherever if there is some structuring is done which is resulting to the lower of than this bucket, then you have to jack up to at least a 50%. Second very important change is mainly on the fixed term or contractual employees. In case of the contractual employees or having fixed term, the gratuity liability will be effective even after completion of 1 year. So normal period is of 5 years, but for this particular specific it is of 1 year. For gratuity point of view, just look at it arises into the having a defined benefit obligation, but the change due to the labor code, it is called a regulatory change. It will be called a plan amendment, and wherever there is impact on the defined benefit obligation, there's increase in DBO due to plan amendment, it will arise on past service cost. So the things to consider here is that all impact if there's a change in DBO. Now the most important thing is if the change in DBO is by what? Is it because of actuarial loss or there are other aspects? But we need to be aware that this particular point is not only because of the actuarial loss. So there has to be a classification of the change of DBO into a past service cost and actuarial loss that need to be tested effectively in during this quarter particular period. Let us first look at AS and Ind AS. Under Ind AS and AS, primarily it more focused on the recognition of and measurement of defined benefit obligation. Under Ind AS 19, it has been very clearly mentioned that the past service cost, if any, is to be recognized immediately in profit loss statement. So as I mentioned in the earlier slide, so we have to be worried that there's amendment in the plant is called a past service cost, and any change in this liability because of the enactment of the law is part of past service cost, which has been clarified by ICI through FAQs. Similarly, on AS 15 also, that it is to be taken to P&L account. If there's unvested benefit, then only for unvested benefit you have to amortize over a vesting period. For remaining all, it all go to the P&L account. Next point is on interim reporting, because November 2025 is the month in which it has been enacted, and now the first is the 31st December 2025 quarter ended. Now the question was that whether we have to consider this or can we safely consider during the year ended instead of considering the December quarter, because a lot of companies in general have tendency not to have actual report on quarterly basis. However, we need to really understand that this is a very important change. We cannot have the similar change, we cannot have similar impact we provide in general cases. This may have impact on your profitability, so it's always advisable from my side that you should have actual report even taken for a December quarter. For events after reporting period, so in case of any periods ending before 21st November, in such case it will be called a non-adjusting event if it is period affecting before 21st November, because 21st November is the date of issue. So thereafter for 31st December, it is obviously adjusting event where we are talking about having actual report and then look at its impact on financial statements. But also it talks about having a disclosure in notes and accounts to address how this has been covered into financial statements. Leave encashments again it will have immediate impact on P&L account. It will be hit both AS and Ind AS both. There has been a lot of discussions about is it an exceptional item or not. Now, ICI FAQ has made it very clear the point that exceptional item is not something which is common. Like it is not like in every case this is an exceptional item. One has to make judgment, one has to make understanding based on case to case basis. So look at materiality, look at non-recurring natures, and based on that, if you feel it is the impact is pervasive, if the impact is material on financial statements, the accountant and auditor can take discussions on judgment about exception item or not. Tax implication, because the allowance in income tax is based on payment base, so that may be arising on deferred tax asset when you provide some higher amount which is not allowable under income tax act, because under income tax act it's allowed only on payment basis. So that also need to be really worked out when you finalize financial statements. So with this friends, I'm sure that this will have really helpful to each one of you, and this is really very critical for all of us to look at, have a discussion with actuary first, uh, to see that they are also aware about the impact thereof. Second very important thing, we should also have a past service cost being separately carved out and disclosed in the actual report, other than the adjustments of its actual gain or loss, because under Ind AS actual gain or loss, which is called remeasurement gain or loss, is a part of OCI. So these are the few things which need to be done. In case if you have any questions or comment, please feel free to be in touch with us. Thank you so much.